Hey, welcome back. This is Mr. Market. We're now into episode 8. Thank you so much for joining me. This past week, the stock market was actually down, but based on our approach, we were able to still make money. That's one of the nice things about selling these put options, is that as long as the market doesn't go below our level, we can still make money. And so for this past week, we were up $422, putting our year-to-date returns to $11,170. We could have made more, and let me go tell you why I didn't. So as the market was falling last week, I had strike prices as high as $408. So it fell below 408. I rolled my strike prices to 407. It fell below 407, and I decided to roll it down to where there was very strong support at the stock market at $405. And it was actually holding pretty well. But by Friday, in the pre-market, it actually fell below it. So I got a little bit worried. But once the market opened, it stayed firmly above that 405 level. But during the midday, it started to fall again to the 405 level. And it got to as low as $405.01. But you know what I did? I lowered it to $404, which reduced my risk, but it also reduced my profitability. And it never got below 405. So I gave up some profit, and let me tell you why. So a couple things. The pendulum algorithm went negative actually on Thursday, and that has a pretty good track record of helping identify weakness in the market ahead of time. And we did see the market get weak on Friday. And whenever I have held fairly large positions as the algorithm goes negative, I've tended to lose a lot of money, and I didn't want to have that happen again. So I played chicken. But had I had a smaller position, I would have been more patient, and I wouldn't have been as worried, and my judgment would not have been as clouded. So when you have larger position sizes, you tend to become more emotional. You tend to catastrophize, what can happen if a position goes against you if you're particularly large. And so, what I wanted to go do was protect myself because of that fear. I wanted to protect myself against that potential loss, but my fears were significantly magnified by my position. There's a saying that goes, scared money don't make money. And that's exactly what happened here. So the key here is that when your position sizes are appropriate, you tend to be more patient with accepting mild losses and watching the market trade at these support levels and to see if it works out. And it did, but because my judgment was clouded, I didn't give it that patience. I didn't give it that time to be patient and let it work out. So there's a lesson there. Keep your bet sizes appropriate, and that will give you a little bit of a clear-headed approach to the market, and it can improve your profitability. Or you could be like me and not do that on occasion and lower your profits. So don't be like me. Keep your bet sizes appropriate. What do we have coming up this week? We also have CPI. That's a big number that has moved the markets up significantly. And I think the market's a little bit worried that, now that we have the narrative that disinflation is well underway, what if disinflation becomes transitory? If you take a look at the charts for the 10-year bond yield, that downtrend has broken. And if you take a look at the charts for the US dollar, that weakness has been actually one of the supports for the market. But now that weakness and that downtrend has also broken to the upside. And when those are reversing, it's not out of the question that it could also lead into the US stock market being weak. And so the market did close below the 9-day moving average, and that puts me in a little bit more of a defensive posture. For this coming week, I am playing it very safe. I am at 395 and 390 on my puts, and I also sold some calls up at 425. A smaller position on the calls, because even though the market is starting to turn down a little bit, the intermediate to longer term trend is still positive. The market's firmly above the 200-day average, firmly above the 50-day average, And the 50-day average recently crossed above the 200-day average, which is often called the golden cross. And typically, the markets tend to have better returns when you have this golden cross configuration. I think in the short term, the market is due for a little bit of a pullback because we've had such a strong January that there tends to be a little bit of a hangover. And actually, February tends to be one of the weaker months historically for the stock market. So we're kind of just following along with the historical patterns. And so I'm being a little bit more defensive, especially with CPI coming up on Tuesday. So that's it. I'm playing a little bit more defensively this week. I think the market might be a little bit scared of what CPI can show. Historically, we've since October at least, CPI has been moving the market significantly. But as the news has been better, showing that inflation has been going down, the market's positive responses have tended to be a little bit more muted. It'll jump in the morning, and then eventually it starts to taper off. And I wouldn't be surprised to see that happen again. But since we've had such a strong jobs number, and we're starting to see the bond markets react negatively, what if there is the potential for CPI to surprise to the upside? And I think that's why the market's starting to break down. They're holding their breath. And once Tuesday comes out, I will adapt and adjust my positions accordingly. So good luck to you. Good luck to me. I hope we all do well. And thank you so much for watching me. If you thought this was helpful, please hit like and subscribe. And I will see you next week.